Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to look at a bunch of different ratios, generally tied to commodities and financial assets. And what we're doing here is we're gauging what market conditions we're in, and we're also gauging what's cheap, what's expensive, and how they are moving. I use ratios for investing. I find my sectors that are really cheap and that are positively putting in bottoms and coming up off those bottoms. And then I sit in them. It may take a good time for these to reverse and move against each other. It may take a couple years. But the moves are so big and the purchasing power gains are so much that patience pays off. It's not 40, 50, 60% gains. It's usually multiple hundreds of percent gains on a relative basis against the two assets. So one asset goes up, the other asset may go down, and you can purchase a lot more of those other assets. That is how you become wealthy. That is how you stack more ounces. And that should be the measuring stick of purchasing power for an investor. Purchasing power is the measuring stick for an investor. So that's how I do it. I don't know of any other way to do it. You can't make money and make less money than all the other assets are going up. You've actually lost purchasing power. So you have to make gains against other things that you want to buy in society. If you're sticking around the precious metals area, generally mass-produced items, whatever they are, cars, staplers, I don't know why staplers come to my mind, you can purchase more of those things. So you can swap between assets and gain against mass-produced items where their costs are declining. But let's dive in. Let's take a look, and I'll give you my financial opinion around it. And if you guys like this type of analysis, if you want to further your analysis in this area, you can definitely check out finding-value.com. Become a platinum member. Use the word discount in the coupon code. And this is how I break things down. It's three pillars. It's ratios that tells us where the money is or isn't and how they're basically inflecting against each other. We have technical analysis, which is just a tool to say that the herd is behaving in such a way that these could potentially move. And it gives us an unbiased way to look at data. And so it's ratios, and market conditions, technical analysis and market conditions. Market conditions are, and you can also see that through ratios, is knowing when what assets perform well under certain market conditions. Then you look at the market conditions, see if they're changing. That's from a low interest rate environment to a high interest rate environment. You could call it the business cycle or the real estate cycle. And certain assets do very well and perform very well under certain market conditions. If you know the market conditions or roughly where you're at, and you know that the ratios are cheap and the market conditions are changing for those ratios to change, that's your opportunity. That's how you do it. So let's dive in here. Let's take a look. So platinum to gold ratio, platinum is incredibly cheap at 0.53. 0.53 is at an area where it's almost an anomaly. Now, we could stay down here for a chunk of time. And when that inflation comes into the markets, generally platinum outperforms gold. So last bull market, we saw that outperformance, and it stayed at a relatively high area during the entire bull market of commodities. That's that whole area. Then we went into that disinflation period. And now I think we are going into a new period where this is going to break out of its downtrend or falling wedge pattern, break to the upside, and move on higher. Platinum versus palladium, it is moving on up. We're at 0.71. And I think we have a long way to go for platinum to appreciate against palladium, given a inflationary backdrop. Platinum versus silver, that one also has a falling wedge, and we've broken to the upside, and we're doing a retest right now. And we could see a outperformance of platinum in relationship to silver, and the market condition it will do that in is an inflationary environment. Then towards the back half of the inflationary environment, silver rips it. So that is one I am going to be looking at, is platinum and silver. Gold to silver ratio, we've got this funky looking chart here. So if we back out, we had an anomaly cheapness in silver. Yes, I did buy a little bit of ounces back here, but then it got really hard to buy because the premiums went gigantic and they ran out. Came on down, another retest, and I think we'll head lower. We're at a ratio of 78. So basically, if you had bought real close to the top here, you would have doubled your ounces in relationship to gold at this point here. And if we go way down to 48 or 30 or wherever, you're going to get another doubling. So it's a double on top of a double. That's 4x your gold ounces holding silver if it gets down to that 30 ratio or so. From the top. Palladium to silver. Continuing to head lower. Silver's at 58. So 1 ounce palladium, 58 silver ounces. We've gotten to lows of 14.15 in this general area. Let's hope we can get back down to that level where silver outperforms. I've got a bunch of silver, but I would love to own palladium if it gets down to that level. I would buy the crap out of palladium if palladium gets cheap to silver, gold, and platinum. That would be the ideal thing for it to happen. Dow Jones to gold. Dow Jones to gold, it is at a cheap, well, it's at an expensive level. It's cheap for gold, expensive for Dow Jones. And there we are right now. And I think we're going to head lower here where gold outperforms Dow Jones. And you can see the big picture view there. The Federal Reserve came into power in 1913. And look at what they did. They screwed it all up. Massive volatility going up and down between assets. Great for an investor, horrible for anyone who lives in this system because of the volatility of it. But that's what it looks like right now. If we were to flip this around, I actually like gold to Dow Jones Industrial Average better this way because you can see that we've actually broken out to the upside where gold could outperform Dow Jones, and we're in that double bottom pattern. So you get a lead in, you get a double booty bottom, and we're at the bottom of that booty. So this is a long-term chart. It's going to take some time. It's not going to be quick, but we've broken the downtrend line. And gold looks to outperform the Dow Jones Industrial Average. And how do we get all the way back up there? Well, under a market condition of increasing interest rates and money rotation into gold, I think this Dow Jones will go down, gold will go up. And that combination will bring it way back up to levels that are way higher than where we are today. So if I were to do it today, it's a green line here, all the way up. I mean, that's a 1,500% difference between the two assets. If we were to go back to those highs back in 1980. Huge outperformance of gold. Gold versus oil. We are at a ratio of 28, and it looks like we're trying to put in a like kind of this double top here. And whenever you get a wick at the top like that, that's generally a good indication that we could go lower. Where oil outperforms gold, that is a possibility. We're at a cheap, very cheap ratio. 1 to 28 is incredibly cheap. So I like oil on a longer term basis, and we're at a very cheap ratio. Will oil take off immediately? Not sure. But I do think over time, it will work its way lower to a ratio more towards around 10 or below. Crude oil versus natural gas. Natural gas is still very cheap, 33. It has made some headway against oil, which is basically oil pulling back. But if gold shoots higher, it's going to reprice all of these assets higher because all of this is being priced to gold. They're all kind of relative to each other. So I do think that natural gas will eventually work its way lower. We're not there yet. Crude oil versus gold. This is flipped. So crude oil is first in relationship. Upward bias, crude oil outperforming, gold outperforming, and then we're going to hit a back test here, and we're going to have crude oil outperform again at some point in the future. Because we've broken out of this pattern, we're going to do a retest, basically where we're at, maybe slightly lower if it were to try to do that. And then it's going to work its way on up. That's going to be a big outperformance of crude oil, and uranium would be a good one too. I don't have the uranium charts because the graph is jacked up. Here is crude oil versus Dow Jones. Very cheap, doing that, the lead-in pattern, the double booty bottom. And that's where let's throw a trend line here, see if we can get a little trend line going here. But we break that trend line, I think crude oil is going much, much higher to a place far, far, far away. We've got Dow Jones versus crude oil flipped around. You can see last bull market. Let's go over here. We had a very high peak. We came on down, broke it, came back up and retested this line here, came all the way back down. This is crude oil outperforming Dow Jones. If we look at the current setup, so here's the current setup. We're doing the same thing, a very cheap area. We've come all the way down, broken the downtrend, going to retest the white line, then go all the way back down to this low level. So crude oil is close to where I think we could turn and outperform all these different assets. And it's cheap still. Dow Jones versus natural gas. Let's take a look at that. Back out. Very cheap up here in no man's land for natural gas. So natural gas is up against this guy. Generally speaking, when you hit this trend line, that's been a good time to be looking for natural gas. And I see it hitting it once, hitting it twice, large selling pressure. It's working its way higher. It's doesn't have that same power. I think this is going to roll back down. Shoulder, head, shoulder, up against the resistance line. TLT versus gold. Gold's just going to continue to rip it. It's just going to go down, 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 where I don't know why people would buy TLT outside of a short-term movement. And then also gold outperforming TLT, looking at it from another perspective, it is ripping it with this vast outperformance. We've got natural gas versus Dow Jones. I flipped these around. You can easily see here, downward market. So Dow Jones outperform, natural gas outperform, Dow Jones, and we've broken that downtrend pattern, falling wedge, doing a retest where I think natural gas will outperform Dow Jones. So there's that there. We've got copper versus gold. We had a scare popping out, another scare popping out. Generally speaking, this also is highly correlated to interest rates. So when we get these fearful environments, generally interest rates come on down. We'll see if this continues or if we're going to get a trend change and move on higher. Right now, by looking at the chart, this is going to continue to go lower until we see a change in the chart patterns. Momentum to the downside, interest rates could go lower in the short term from fear in the market. This here is 08. You can see the fear in that market. Money rotates differently under that fear, and it generally goes into gold and silver, the precious metals under those market conditions. And then we've got the BDI to gold. I know some people said, oh, this doesn't mean anything. Yes, it does, guys. Gold is basically your measuring stick, and then you're just pricing assets against the measuring stick. But very cheap in relationship. This relationship is Baltic Dry Index is cheap. We can also see that we've got some sort of wedge pattern that has developed, and we've broken it to the upside. So that's what we've got for today, guys. That is the ratios. By just looking at this, I know I didn't go over uranium. Uranium is also incredibly cheap in relationship to gold and other assets. We also have the uranium equities that are really cheap in relationship to uranium futures pricing. So that is also another very cheap area. Uranium's incredibly cheap, and for the patient investor, I think it offers gigantic, lopsided, asymmetric opportunity to the upside. These are all monster patterns. Monster patterns are my quote is, monster patterns change lives. If you can trade or invest off these monster patterns, and you have the ability to hold on and ride them all the way up, where these ratios go from extreme low to an extreme high, that's where you create extreme wealth. But you have to hold it for 5, 10 years. It doesn't take, or longer. Like here's Baltic Dry Index. Baltic Dry Index, if you held it from 1980 to the peak of 04, 07, at least in this ratio, you increase your purchasing power from 1 to 14. So you increased your purchasing power against gold by 14 times if you had played the Baltic Dry Index directly. And maybe the equities outperformed it, maybe they didn't, but at least the Baltic Dry Index did. And that's how you do it. You just find, like platinum right now is incredibly cheap. I buy a bunch of it and I just sit in it. And it may be 5, 10-year hold. I did that with palladium. I bought it in 05. I bought it in 2009. I held it all the way till April of 2020. And then I swapped it for platinum. I bought it in the 200s USD. 200s, I think I got some in the 300s too. I sold it when it was about 3,000. So it was a 10-bagger from the metal itself on dollars, but it was a vast outperformance. We can go back real quick. I can just show you. Oh, I don't need to go very far. So platinum to palladium is this, I think it's this one here. Yep. So when I bought it at these ratios. It was like 05-ish, and 09 it dipped. So I bought it in these general vicinities. It went from 5, 5.5, and 5, so let's just call it 5, all the way down to 0.32. I swapped it at 0.35. So what was my return in terms of platinum? And I swapped it for platinum because silver was really hard to get. So I got a lot of platinum. I was gonna divvy it up kind of between the two, but I got all platinum. So if it was 5 and you divide it by 0.38, I think is where I swapped mine, I got a 13 times increase in metal. I got, for every ounce of palladium I purchased, I got 13 ounces of platinum equivalent. That is called real wealth. And you know what? You know what's crazy? What risk do I take buying precious metals? A lump of metal. No management risk, no tax risk, no risk of any of these things. And guess what? If they tax the companies that produce these things, if they make it harder to create mines, those are all strengthening. That's just strengthening the thesis to own a bunch of metals, the actual physical metal, because they're just driving the cost curves higher, higher, and higher, and they're driving lead times longer and longer and longer to respond to whatever problems there are in the market. And you've also got declining energy return on energy invested, which means, and declining ore grades, which means that the cost curves continually go higher. So you could argue that the metals are the safest on a risk-adjusted basis. They're the safest, greatest reward-risk ratio in the markets of anything. They cannot go bust. They cannot go to zero. They cannot go bankrupt. And these ratios just move against each other over time. So if you play the ratio game, you're basically protected against inflation, protected against deflation. Because remember, it's all relative, guys. Even if you have everything fall, you still make purchasing power gains. If cars get cut in half because of deflation, used cars or whatever it is, and yours only goes down 10%, you still won. You can buy more of other things. Then you swap to other assets when things are way down and ride them on up. You just keep swapping over and over, making a lot of purchasing power gains. But that's where we're at today. If you guys are interested in this stuff, definitely sign up to the website or subscribe to the channel. I do this about once a week, and we'll look at some other ratios as well with ETFs to see how they're performing as well. But that's what I've got for today, guys. We'll catch you next time. This is Finding Value.